Hi. So given what happened in the past 2 days in the Treasury and the stock market, I wanted to give a quick research update. So let me start with a research report that was published on September 25, entitled Crunch Time, the Great Squeeze of the Treasury Market. And really the thesis is in the title. This was the end of September, and I was looking at Q4 supply and demand, and I thought that there was going to be a massive imbalance. So we have about $2 trillion of Treasury debt that's going to mature in the fourth quarter, most of that in the first 2 months of that quarter, and about 441 billion in new issuance according to the Treasury. So these numbers are really extraordinary. I mean, the only time we saw anything that came close to that was back in 2008 when the deficit just soared to close to 10% of GDP. But of course, back then we had QE, the Fed and all other central banks were expanding their balance sheet. There was a lot of demand for safe haven assets, so that supply could be absorbed. This is no longer the case today. If anything, QT is accelerating. So this month, October, is going to be the first month where we see the new cap on divestment from the Fed to 30 billion on treasuries and 20 billion on mortgage-backed securities. So that means that there's potentially 50 billion of securities that used to be rolled over that won't be rolled over, and we'll need to find a new buyer. We're seeing a similar tightening from other central banks. The European Central Bank is cutting its monthly purchase from 30 billion to 15 this month, and then it's going to end in December. Even the central banks that don't have a quantity target, like the Swiss Central Bank or the Bank of Japan, have been cutting down quite aggressively on purchases. So that massive tide of central bank liquidity is quickly receding at a time when we have a lot of issuance. So the bullish case for for the treasury market is that the US dollar is still a world reserve currency, and that if yields rise enough, foreigners will come and buy. And that's essentially what happened back when we had also very big deficits in 2002 when we had the Bush tax cut. We saw massive inflows from China and from sovereign wealth fund that prevented yields from rising too much, even though we had large deficits. I don't believe this is going to be the case. And you have to understand that back then, China was buying because China had a current account surplus of 7 to 10% of GDP and was pegging to the US dollar. Today, China has a small trade deficit, and China is no longer pegging the RMB to the US dollar. So China does not need to accumulate reserve, doesn't even have the surpluses to do so, and certainly doesn't have the willingness to do so. I mean, China's overwhelming goal is to move away from the dollar, to de-dollarize its trade with its trading partners. So it no longer needs these massive hoards of, close to 3 trillion in currency reserves. On the sovereign wealth fund side, the great accumulation of sovereign wealth fund happened during that big commodity boom of 2002 to 2014, when prices were rising and sovereign wealth fund were just constantly accumulating assets. The exact opposite is happening today. We're seeing increased spending in many Middle Eastern countries due to wars and demographic pressures, and generally outside of oil, weak commodity prices. And even within the oil market, we've seen a shift of production from OPEC into Canadian and American shale producers, which mean that sovereign wealth fund actually shrinking instead of growing. The last argument in favor of the treasuries was that yields are much lower in Europe and Japan, so eventually European and Japanese investors would come in and buy US treasuries. And that is actually quite unlikely because the currency hedging costs are very high. If you are a European-based investor and you want to buy a 5-year treasury, but then you want to hedge the currency risk by selling the dollar forward, you will lose in terms of your forward sale what you gain in the yield. I mean, that's basically common interest rate parity, and it works even worse than that actually, because there's so much demand for currency hedging. The spread is actually even more negative. So if you're a regulated investor like a bank or an insurer, that really doesn't make all that much sense. So the conclusion that I made in that report was that we'd see a lot of issuance, and we really had no natural buyer for that issuance. And this was especially risky because we came at a time when US yields were very close to a key support levels. I mean, 1.15 on the 10-year and 3.2 on the 30-year. So if we broke these support levels, resistance, there was really nowhere else to go. Like, there is no obvious point where the treasury market the sell-off could stop, and instead it would accelerate, which is indeed what we saw. So this led me to my second report, which came on Wednesday, which was called a stupidly verifiable forecast, a liquidity case for an October-November correction. And the case here was that this big treasury sell-off would eventually spread over into the equity market. Um, and the reason was, that the supply and demand conditions were actually worse than I even thought. One thing that I was only looking at the treasury market, but if you look at the global bond market, you usually see a lot of issuance in October and November, and that's just a calendar effect. I mean, people are gone on holidays during the summer, and people don't want a price deal in December because it's too close to the year-end holiday. So usually you see new debt offerings about 10 to 20% higher in October and November. And because we had such heavy issuance in prior year, you have a lot of rollover maturity. So I found on the Bloomberg that we have 5.3 trillion global debt that will mature in the next 2 months. So clearly a lot of supply. Another reason that got me worried about the equity market was the fact that there would not be buyback demand in the next month. As you know, when we are in earnings season, U.S. companies cannot repurchase their own shares. And really, the biggest bidder for stocks in the past year has been companies themselves. We've seen buybacks of about 200 billion a quarter this year. So if we have a correction, as seems to be the case, there won't be the bid, the natural buyback bid, which means that the sell-off could accelerate. Now, I want to kind of make sure to disclaim that these kind of short-term forecasts are inherently very, very risky, and what we need to take into account is the probability of being wrong. And I think in the case of this equity market call, there's two ways my call could be wrong. One is that it could be too early. The liquidity crunch may be years ahead. We had so much liquidity injected in the system that, there's still a lot of excess liquidity. For example, there's about 1.7 trillion excess reserves sitting at the Fed and 1.2 trillion in Europe. So clearly there's some money that could potentially go into the market to buy on the dip. That being said, most of the excess reserves in the U.S. are from the big five banks. If you look at local and regional banks, they actually don't have any excess reserves, and you can see that the funding markets are normalizing. For example, the Fed funds rate is starting to converge or even sometimes exceed the interest rate on excess reserve, which means that we're starting to see demand for funding come back again. Another point I would make on the banks is that they may have the liquidity to buy treasuries, but they may not have the economic incentive. I mean, remember that if they park money at the Fed, they earn 2.20%. So even if the 10-year is at 3.2%, the real spread is 1%. So they're taking 1% in extra yield in exchange for 10-year of duration risk. And that's not a very attractive proposition. So it could be that the bank bid will come, but it will come at a much higher yield. The second way that my forecast could be wrong on the equity side is if we have another gangbuster earnings season. I mean, the strength of U.S. earnings this year has been amazing, and in many ways it explains why the U.S. has broken out from other global equity markets which have corrected. Last quarter, we have 85% of U.S. companies that beat earnings. We saw 20% plus earnings growth. So I actually think it's likely that it's going to happen again this quarter. But what I would point is that after so many surprises, the market expects, the level of expectations has increased. The market expects to be surprised. And so far, we only had about 20% companies that are, 20 to 30 companies that have reported in the US. And the reports have been good. I mean, most companies have beat earnings, and, earnings are growing by 20% again. But what we saw is that even the companies that beat earnings sold off, meaning that the market now expects to be surprised. And this is very much like what we're seeing in the economic surprise indices. So we have very strong US economic data, but the Citigroup Economic Surprise Index for the US actually going down because the consensus has caught up. So we are at that point where, good is not good enough. The expectation is that things will keep getting better and better, which of course is eventually unsustainable. So my outlook remains that, things may get even uglier in the treasury market, and that the equity market remains quite vulnerable to this correction, and that this correction could take us much lower on the downside. Thanks for listening.